Okay, so let's talk about model 1. Okay, so for most of my models, my trading models, I use the same form of confluence because market is dynamic and it's forever changing. You cannot stick to the same model because you might not always find it. You must learn to be flexible when you're trading. It's the first model I use. Right. Let's start with the first trading model. Trading model model 1. Now, for my trading model, there are 5 types of confluences I use, right? So for instance, I have a higher time frame, right? Liquidity grab, which in other words, basically, it's a sell-side liquidity that I use. It must be sell-side liquidity. I have a higher time frame point of interest, which can be an order block or something else. Point of interest, excuse me. All right. A market structure shift, okay, a fair value gap, right, in discount, right. I'll explain further, right. And most importantly, I use a 1:3 risk to reward. Okay, so these are the confluences I use in my trading model. Okay, very simple and straightforward. These are the confluences I use. This is what's expected of my trading model. All right. Now, what I'll do is I'll draw what trading model 1 will look like. Let's go to model 2. Right? So this is what model 2 will look like. Right? So, first thing first, my confluence, a higher time frame, liquidity grab, point of interest, a market structure shift, and what we call an inducement, right, which is basically an internal liquidity. I call it internal range liquidity. Don't worry, I'll put all the meanings of all these abbreviations I'm using, like IRL, IDM, POI, MSS. I'll put it down. Then, of course, I must have fair value gap and discount. And then also, right?
Or premium, discount or premium.
That's about it. Now I'm going to show you an example of model 2 on the charts and what it's supposed to look like. Okay, so let's go to model 3. Model 3 is my favorite. I always use it. And honestly speaking, it's one of my most successful. Number 1, you need what we call liquidity, higher time frame liquidity, right? liquidity. Liquidity grab, right? It can be SSL or Buyside Liquidity. I'm so sorry I forgot to mention Sellside Liquidity or Buyside Liquidity. Number 2, you need to have a higher time frame POI, right? Point of interest. Number 3, you need to have a break of structure, right? At least a minimum of 2 to 3. Okay? Why? Because a break of structure is a form of confirmation of the continuation of trend. Number 4, right? There has to be a fair value gap, right? Number 5, there must be inducement. That's number 1. There must be inducement. And this is my favorite. I always see it all the time. There must be inducement. It's a high probability. This one, high probability, right? There must be an inducement. High probability. Okay. Absolutely, high probability. This is my favorite. And I love it. And I definitely all the time, I see the FVG must be within a discount level. Discount or premium level, right? I will explain further. This is my favorite and my most successful model. Okay, now let's go to model. Right, so I'm going to show you an example of what trading model looks like on the charts. And then we'll go back to trading model 4. Model 4, sorry. Now, model 4 is something I use sometimes when I want to catch short trades. Number 1, higher time frame, liquidity. Number 2, they must be a break of structure. Absolutely. Or even a market structure shift. I'm just being open-minded. Number 3, they must be a fair value gap, a clean one. Number 4, we should have something like a breaker block. This is for a model when there's a breaker block, a BB. Okay? So this is my model when I use it. It's clean, it's accurate, and it's good actually. You're able to ride it for a short period of time before the main move continues. It's for a short temporary move, but it's good and it's clean. I thoroughly enjoy it all the time, and I use it and it seems to work. So this is what must be met. Higher time frame liquidity. There must be a breaker structure or market structure shift, a fair value gap, and then we've got a breaker block. These are the model I use. So I'm gonna go to these are the confluences I use for model 4. So I'm gonna go on the charts and I'm gonna show you what model 4 looks like on the charts. All right, and then from there we're gonna go to model 5. Model 5. Okay, for model 5, it's quite a unique one. All right, it's quite a unique one, and we've got what we call it's a setup that's unique and not many people understand it, but it's a very popular one and it's quite common. There's what we call accumulation, manipulation, and distribution. Basically, the consolidation box. Now, this one you need to be really good and patient with it. All right. Okay, so the conditions that must be met for the consolidation box or AMD setup, right? AMD setup, and then the consolidation box. Now, number one, you need a consolidation range, right? So there must be a consolidation happening, right? Number two, you need a higher time frame POI. It can be a form of anything. Number three, you need a liquidity grab, right? A higher time frame liquidity grab. It can be equal highs, equal lows. Then it needs to retest, right? You need a retest. I'll explain further what we mean when we say retest. Now let's go to the charts and look for an example where all these conditions are met. Watch out for the next videos as I drop the live chart examples of the trading models.